Hello and welcome to the Flying Frisbee with me, Dominic Frisby, also known as Money Markets and More. And as I talk, overnight, gold has just spiked to all-time highs, $2,150 an ounce, albeit briefly. Is this the beginning of more new highs, or are we about to capitulate? Who knows? We're about to find out. But sitting with me today is my friend Josh Saul of the Pure Gold Company, and I love talking to Josh because he has some unusual insights into the gold market, insights that you don't hear anywhere else because of the research that he does with his customers. He finds out why they're buying, who they are, and so on. And so you get insights you don't get elsewhere. So Josh, welcome to the show. And I suppose the first question to ask you is, who's buying gold and why at the moment?
So, in fact, one of the biggest questions that we're asked at the moment, and take into account that we work with a real range of clients from investment bankers to doctors, lawyers, judges, but we also work with people that aren't necessarily financially literate. You know, they might be doctors, they might be postmen, they might be engineers. The one big common denominator at the moment is people are asking, what on earth do I do with my money? In the face of so much adversity. You know, we've got conflict, we've got interest rate rises, we've got, you know, the contraction of growth. And so people are very concerned. We have had, over the last 4 weeks, for November 2023, a 412% increase in people purchasing physical gold bars and coins compared to our monthly average.
Now, is that because you're offering an extraordinary service and you're just outdoing your competitors, or is that just people are buying gold?
I'd love to say that it's down to us, but actually I would say that it's down to the market. We are largely being reactive to the market. Inquiries are up, call-ins are up. People are concerned, and actually people aren't really looking at the price. They're not looking at the gold price. They're not looking at gold performance. They're looking at safety, and they're looking at security. They're looking at wealth preservation.
And where's the money coming from? You mentioned before some of it's coming out of pensions, some of it coming out of real estate.
We've seen over the course of the last 12 months a lot of people wobbling over the prospect of not being able to afford mortgage payments that are likely to be 400% more than when they took out their property or when they took out their last mortgage. And so you've got some people that are deciding, well, you know, what's important to me? I'm going to have to compromise on something. You know, I can't afford to pay 400% increase in my outgoings with a 400% increase in energy. And so do I decide to send my kids to a different school? Do I decide to go on less holidays? Do I decide to spend a lot less money? These are all things that I think a lot of people are thinking about. That's probably contributed to the fact that we're seeing a contraction within the market. People are spending less money. Businesses are feeling that. It's creating unemployment. But back to the issue, that's resulting in people trying to sell property. You know, there are that segment of the market that believed, you know what, I'm going to sell my property, I'll downsize, I'll move to an area that isn't as expensive. And in doing so, they're then left with a large amount of cash that they would otherwise have to leave in the bank. The problem with that is I'm hard-pressed in seeing a more uncertain time for the banking industry. You know, we've seen Metro Bank, its shares fall by 30%, NatWest trailing closely behind. A lot of experts believe there's going to be a big consolidation in the market. And yes, we're led to believe that anything under £85,000 is covered by deposit protection. But anyone that has more than that in their bank account, they're not covered. A lot of our clients believe that the 85,000 is academic. You know, has it really been tested? You know, have we really explored the option? And so I think for a lot of people, they're taking a huge punt in, you know, taking that at face value. So, you know, leaving money in the bank that is exposed to counterparty risk, which removes the accessibility of being able to get that money out when you need to, that being obviously a worst case scenario, but it's something that a lot of our clients are starting to see more of. I think at the moment, the only certainty within this market is uncertainty. People are expecting it. If we look at the other side of the fence, we've got inflation. Whichever measure you choose to look at in terms of inflation, you're guaranteeing a loss of around 4 to 5% per year. If you decide to take into account, energy and other items that actually should actually increase the average inflation figures, it's probably a lot higher. But if we go with 5%, if people are leaving their money in bank accounts so that they can find the perfect home, the perfect property, the perfect investment, knowing full well that there are a lot of people that see huge amounts of opportunity in times of uncertainty, like the moments that we're in. The problem is that as we're waiting for those opportunities to arise, and we need to be sure and not pressurized by urgency. Sometimes the hardest thing to do is nothing, right?
Yeah.
And it's hard because you always feel like you've got to be a steward of your own wealth. You've got to be responsible. I need to do something. And so I believe that the inflation narrative has pressured a lot of people into thinking, I've got to do something, even if it's this or even if it's that. But I believe that the smart money, they're motivated very, very differently to the rest of us. They're not motivated by price. They're motivated by value. Price is what you pay and value is what you get. And I think what sets the wealthy or the smart money clients from, the rest of us is that they can wait patiently for opportunities to present themselves. And so waiting patiently might be leaving your money in a bank account and waiting for equities to rock bottom out. It might be to wait for your perfect property at a 30% discount to its normal retail value. But that doesn't come without risk. You've got the counterparty risk, and then you've got the guarantee of a loss of purchasing power. Mm-hmm. And so the way our clients see it is that you can actively wait. And actively waiting, as opposed to passively waiting, is putting your money in something that is physical, something that's tangible, and something that tends to increase in times of uncertainty with no tax to pay and capable of being liquidated.
Okay, so you're seeing this incredible rise in volume. You're seeing people almost sounds like they're using the patient's money is buying gold and using it as a holding vehicle, but you're also seeing presumably long-term investment. You're seeing money coming out of real estate. You mentioned before the interview started, money coming out of pensions. Tell us about that.
Pensions are a huge area that we see. When people start to save for pensions from, as early as their 20s, their 30s, their 40s, people have started to take far more of a vested interest in what their pensions are going to look like. We know that, inflation is getting to the point where when we get to kind of pensionable age, who's going to look after us? But I think the point is this: when they change the pension rules from annuity income to us being able to receive one big lump sum, a 10, a 15, a 30% fall in the value of a pension in a lump sum, you feel far more than maybe 15 or a 20% fall in the value of income that you would get from your pension. And so people have taken a far more of a vested interest in pensions in their entirety. What we've seen is that pensions, naturally speaking, are exposed to equities, bonds, cash. They're the kind of investments that you don't necessarily actively manage day to day. And, if we look at the market, we know by implication that the markets correct themselves every, 10, 11 years, right? They're cyclical. We understand that is going to happen. What a lot of people tend to do with their pensions is they ride the market up for 10 years. They do really well. And then all of a sudden, they lose 30 or 40% of that growth. And they're left hanging on for another 7 or 8 years for that to grow and mature again. The problem is that a lot of people don't have that time. They're getting to pensionable age. They want to be able to liquidate their pension, do what they've always wanted to do, look after their kids or their grandkids. They might not have the 7 or 8 years for their pension to recover. Will it recover? Yeah, it will. History shows us that whatever goes down will come back, but we don't last forever. We don't live forever. And so what the smart money do, instead of this dance, 2 steps forward, 1.5 steps back, and then in 30 years' time, you're marginally ahead of where you started. If we look at the smart money flow index, what it does is it shows us from an institutional point of view, the flow of funds from the equity market. It's not going to log things like, ultra high net worth individuals purchasing, but what it will log are the large institutions, the banks, for example, the hedge funds. And these institutions, they're not always waiting for the top of the market for them to crystallize their profit within the equity market. They'll look at fundamentals across the market. And what we've seen is a huge outflow of smart money out of the likes of the equity market, despite the fact that it's continued to go up again. And we've seen those inflows into physical gold, right? And that we can see evidenced by the fact that the gold price is increasing. And so if I bring this back to the retail market, we've seen clients that have lost over the last few years a lot of money within various markets, whether or not it's bonds or equities. And so over the last 12 months, I think the figure is around a 296% increase in people that have removed exposure to equities or bonds or cash within SIPs or pensions to purchase physical gold bars within the same vehicle. This is an area that we pioneer in, being able to provide that consultative approach in terms of guiding clients how to do this, if they should do this, and the mechanics of how to do it, quick enough in order to remove risk, but benefit from any sort of upside in the gold price.
Okay. Now, where's the gold price going? I know you've got to be careful about what you say, but you mentioned you thought it was maybe 20-25% undervalued relative to the amount of risk that there is out there at the moment. That you said that before we started.
Yeah, it's a difficult question to answer, given that everyone has their opinion, and there's a 50-50 chance that we're right or wrong. IG Wealth believe that we're around 20% lower than where the gold price needs to be. And they believe that we're undervalued based on safe haven demand and the fact that the market believe there's going to be central bank rate cuts later on in the year. I believe that the rising cost of debt has put us into a position where people are going to have to either default on debt. We've seen a 33% increase in the amount of people that have missed mortgage payments. And if they continue doing that, they're going to have to either reactively sell their property or proactively sell their property to avoid that in the future. Interest rates, I don't believe, are going to go back to where they were. And so from a global point of view, if central banks decide to cut their rates, then that's going to devalue the dollar. It's going to strengthen the value of physical gold. And if we're looking at the backdrop of all of the risk within the market, yes, we've got the cyclical stuff, the stuff that you predict, equity corrections, property corrections, inverted yields in bonds and what have you. But then you've got the black swans, and they're starting to happen with increasing frequency. You can't predict them, but I think if the last 5 years is anything to go on, we can certainly anticipate them.
Okay. So you would agree that 20% undervalued figure, give or take?
I would agree with it.
Yeah.
I mean, put it this way, I wouldn't be shocked if the gold price were to increase by more than that over the next 12 to 18 months. That being said, a lot of the institutional market want gold lower so they can put more of their funds into it, so they can get that protection while they need it.
Okay, so most of the reasons that you've described people buying gold is to do with fear, uncertainty, doubt, people buying gold for insurance. If people buying it for greed?
You're always going to get a part of the market that are looking to make money, right? That's never going to change. Most of our clients, when they come to us, they're either aware of problems within the market or we'll make them aware of risks within the market. If they come to us and say, I'm looking to buy gold because I want to make a 20 or 30% increase over the next year. For us, it's our job to manage expectations and say, first of all, physical gold shouldn't be looked at as a short-term investment, right? It has to be looked at as a longer-term contrarian play. If we look at history, we know that over the last 40 years, gold has increased by 11,000%. Over the last 20 years, 500%. The last 10 years, 107%. The last 5 years, it's been 68%. And the last, I think, 3 years has been around 20 to 25%. And so you can't blame people for looking at those headlines and wanting a piece of it. But I would say that a large part of that contribution in gold's ascent have been from people that want safety, security, and inflation hedge. I think the fact that it's one of the very few asset classes that you can purchase, grow, and not pay any tax whatsoever on the gain makes it even more compelling and a lot more attractive.
Okay, now, what is the future of gold? Now, I see there's sort of three scenarios. There's one where gold's future is jewelry. There's two where gold's future is jewelry and insurance, money out of the side of the system and all that. And there's three where gold actually has some kind of monetary role to play once again. What do you see as the future of gold?
What I know is that last year central banks collectively purchased 1,146 tons of physical gold, which was the largest amount of gold that's ever been purchased in any year. This year, we're already up 14% on last year. And so
when's the end of the year?
Sorry?
When's the end of the year?
The end of the year is December.
Oh, okay.
So we're already up 14%.
I thought it might be March, it might be the tax year or something, but yeah.
And if the central banks are anything to go by, given that, a lot of the financial world take their cues from the central banks in terms of what are they trying to remove exposure from. Generally speaking, people are trying to avoid the dollar, right? Ordinarily, in times of uncertainty, they would hold the greenback. And that's not happening anymore. So various countries, in fact, every single central bank in the world, other than I think Russia, are net purchasers of physical gold.
Not the UK.
The UK they're still buying physical gold in small amounts, as are every other country. And so I believe that, gold's one of the oldest forms of currency and stores of wealth that we've ever known. It predates a lot of us today. It's been around for thousands of years. People used to barter it as a means of exchange. The world's becoming far more digital. People start to talk about CBDCs. CBDCs for some people represent a huge amount of change, but at the same time, it also limits and restricts control and autonomy. The fact that every pound or dollar we spend is trackable, that effectively we're contributing to the huge data analytics, which effectively will govern us. Physical gold's always been a very effective transfer of wealth, either externally or generationally within families. And so I personally believe it will always be one of those asset classes that will allow you to get your money out of the banking system, away from counterparties, and it will allow you to grow wealth, as we've seen it has done over the last 10, 20, 50 or 100 years, in a way that allows you to pay no tax whatsoever.
My stepfather left Johannesburg in 1979 with 50 Krugerrands in his bag. So
he's done pretty well.
Yeah.
He's done
still got them, but yeah.
We've had clients that purchased physical gold in the 1970s. And back then it was, our purchase some physical gold as an insurance policy because, my grandparents said that was a good thing to do. I'd much rather hold something that hedges against inflation as opposed to just keeping cash that doesn't keep up with it. And for a lot of those people, they kept it in a shoebox and they had no idea what it was worth until they spoke to someone like us, and we were able to report an 11,000% increase in the value of their portfolio. they're then faced with a dilemma as to whether or not they sell or whether or not they purchase more.
Mm-hmm. Well, so most of the central banks that have been buying gold in the significant quantities are on the Silk Road. They're part of that Shanghai Cooperation Organization. And we do know that there's a definite move there to de-dollarize because those countries aren't all great friends of America and they don't want to be beholden. Russia's the exception. Russia's a net seller, I think, at the moment.
They were a significant net seller right before the war that they inflicted on Ukraine. And so the big question is, who funded Russia? Who bought Russia's gold off them in order for them to have enough cash to pump into their military force?
Who bought their gold and where did the transaction take place?
Yeah. No one knows. Obviously, there's lots of speculation out there. There are lots of countries and central banks out there that aren't as transparent as other jurisdictions. And so, and this isn't me pointing fingers because no one knows, but there are certain regions like China, for example, who don't disclose accurately how much gold they hold. And so it would be impossible for us to confirm or deny whether or not, it was someone, whether or not it was a country like China or India, for example, that purchased Russia's gold off them.
So, but let's say Russia sold 10 tons of gold. How would it have to ship that gold to Shanghai, or would there be, is there some kind of counterparty, like who is Switzerland there?
I think when you're talking about a country like Russia, I believe there's probably an element of trust that would require a buyer to want to receive that metal, as opposed to it just being kind of allocated to them within the boundaries of the country in which it's being sold. And so, often is the case that the other countries step in and provide a safe harbour for these sorts of transactions. You mentioned Switzerland. The Fed would have been an obvious example, Fort Knox, but I can't see them stepping into transactions like that. But if we use other countries...
Even Switzerland, I can't see doing it.
I can't see... there's too much to risk for a lot of countries. Would China or Shanghai, would that be a platform in which transactions like that could take place? Maybe.
China must have ambitions for the Shanghai Gold Exchange to be similar to the Fed or something. It must have those ambitions.
I believe so. But I also know that the Chinese central bank purchased more gold than most other countries around the globe.
Yeah, and they don't declare it.
Yeah, and so if you wanted to sell gold quickly, they would be your obvious first choice.
A lot of reports I'm hearing, and from people who study capital flows and gold flows and all the rest of it, a lot of gold is making its way to the UAE. And so maybe the UAE is going to be, geographically it makes sense, and in terms of political alignment it makes sense. Maybe the UAE is the next Switzerland.
I would agree with that. It's bang in the middle of the world. And they've become quite westernized in their view of relationships as a kind of democratic country, kind of creating ties with everyone. And so I think they position themselves well for them to provide a platform that facilitates transactions like that.
Well, if they do that and, the Shanghai Cooperation Organization start de-dollarizing and using gold, which they can all trust, then the future for gold is a bright one.
Yeah.
Josh, if people want to find out more about you and what you do and the Pure Gold Company and so on, how can they do that?
Well, the first thing is to visit our website at thepuregoldcompany.co.uk. But I believe you're going to
link in the comments.
You're going to put a link at the bottom of this video, and so customers, users, readers can download an investor guide. We ask a couple of questions that allow us to bespoke the guidance and the reports that we send out to our clients. It's something that's relatively new, but it helps us give you information that you want as opposed to information we think you want. You can book a consultation whereby one of our consultants can explain how the market works. We can give you guidance in terms of how, why, when to do something like this. We give guidance in terms of physical gold, physical silver, how to purchase physical gold within a pension or a SIP. But I think that the most important element at the moment, whether or not this isn't something that you wish to do right now, is be armed with information, because information is absolutely key in being able to make moves when you need to make moves. Often is the case, we may well say, this is something that you clearly wish to do. We see there being a buying opportunity in the next 7 to 10 days. We would suggest waiting for 7 to 10 days in order for you to pick up more protection for less money. Sometimes it's completely the opposite. It depends on what's happening, within the market at the point at which we're speaking.
All right. Well, good stuff. Thanks very much, Josh. And thanks very much to you at home or on your phone or wherever you're watching this program for watching or listening. And I'll be back with another show very soon. Until then, goodbye.